Welcome back to another episode of Cashing Out. I'm your host, Billy Alvaro, my co-host, Wayne Hartart. We're here with a special guest today, Rick Haberman. Second time on the show, Rick Haberman from the Rock East Group. Rick, how you doing?
Good. How are you?
Doing phenomenal. Doing phenomenal. We are Easy Sell Property Solutions, as we said in our last segment. We buy properties all day, every day for cash. We have a very unique program called the Easy Way Out. And if you're out there and you want to sell your property, let me explain to you that the Easy Way Out literally is the fastest, easiest, most hassle-free way to sell your property in today's day or any day, because we are buying all cash. There's zero contingencies. We make you an offer and we close on your timeline. We've gone into, numerous episodes of all the benefits that we offer to the sellers out there. But today we want to focus on private lending. We had Rick on our show last week speaking about the differences between cash buyers and private lending. Rick owns a private mortgage bank. Rick, what I want to get into today is I want to educate investors like myself on how they could leverage your product, what your underwriting criteria is, your rates, your fees, the process to draw down funds. Let's get into all that. We'll start with the rates and fees and the LTVs. So let's talk about that, what that means, and what the range is that you guys offer.
Okay. All right. Sounds good. Well, as you said, we have a range of fees, depending really on what the investor is looking for, as far as how much he wants us to fund of the purchase, how much he's looking for us to fund of the renovation costs. So depending on how much money we are advancing will depend on the type of fees that we're charging, rates and points, stuff
okay,
like that.
so for understanding, so if it's a $200,000 purchase and the properties he's buying it for $2 and it's going to cost $100 to renovate, so you're all in for $3, you're going to base your loan to value off of your total deal cost. So he'll have to come in with either 10, 20, or 30% of his own money.
Correct.
Okay. And depending on where that criteria is, how much of his own money he puts in is going to determine what his rate and fees are.
Correct.
Rate and points.
Correct.
Okay.
So, and also it will depend on, we talked about the appraisal.
And his credit.
And his credit. So the appraiser will go out there and give us a value based on the amount of work that the investor said he is going to put into it, and we'll come up with his after repair value. We don't like to be, we will not be any higher than 65% of that appraised value.
So your total lending out will not go greater than 65% of what the total deal ARV is.
Of what the appraised value comes in at.
Okay, so that's good to know.
So if you're back at that number of the $300,000 all in on the 200 purchase and 100 renovation, if the appraiser comes in at $500,000 what the house will be worth, we don't like our loan. We won't have our loan any higher than 65% of that $500,000.
Of that number. Got it. And if it is higher, then you're going to cut it back, and they're going to have to come into the deal with more of their own cash.
Correct.
Makes sense.
But if they're getting such a great deal where if they 200 and 100 was the 3, I don't have a calculator
about
on
300,
it.
right?
Right. What would it be? And it winds up saying I'd still be safe at my 65% on a $500,000 number. I still will not fund 100% of that deal.
It's still going to be 65%, or I get it.
Okay, so I'm still going to require some skin in the game, as
their own
we
money.
say, right?
And how much minimum of their own money do you want them to have in? What's the minimum amount they can come to the table with of their own?
Minimum, we will fund up to 90% on a purchase price.
So they have to have at least 10% of their own money into the deal.
And we will fund up to 100% of the renovation costs.
Wow. Okay, so that's actually strong.
Compared
to a lot of other lenders out there, that's very aggressive.
Yeah, that is.
So as long as where you feel, again, it's the criteria on the investor, what the appraised value of the house will be.
Is that based on how many deals that investor is specifically doing, or his track record?
His track record. With our company, our customers are repeat customers, so we've got to know them. We've been in business since 2010. We've had clients since the beginning, so we have a track record with them, so we can be a little bit more aggressive with them.
Yeah, so when we first went to him, he was more conservative, and then as we started doing deals, they started loosening up their guidelines, giving us some more leniency, cutting down the interest rate, cutting down the points, and increasing the overall loan to value. And what I like about your company, and I said it in the last show, is that it's the personal aspect of your business. It's really, even though you're a family-owned and operated real business, you still have that personal touch to it, where you and your brothers have relationships with guys like us, and you're making the deals happen. You're not an originator handing it off to an underwriting department. Like, you're really doing it all
Correct.
yourself.
Correct. So if you call and you Rockies Group, you're going to speak with an owner, because you're either going to speak with myself,
Right.
my two brothers, and my dad. Not so much anymore. He's
Right.
in the background, but you're going to either speak to me or two brothers. So you're always going to speak with an owner. You're always going to get an answer to your question, and it'll come from us. So we're not, like you said, passing it to, let me get my underwriting department, let me get my closing department.
Sure.
I am the underwriting department. I am the closing department.
Right.
So
You
it's
have
all-
that personal touch, which I like.
Yes.
I like that. So so we spoke about the loan to values and how much money they have to come in. Let's talk about the range in interest rates and the range in points that you guys offer and the reasons for the differences.
Okay. So if you're looking for the full amount that we can give you, you're looking at a minimum FICO score of 620, and you want 90% of the purchase price, and you want 100% of the renovation cost, you're looking at rates of anywhere from 11 to 12%.
11 to 12.
And 2 points.
11 to 12 and 2 points. So if you're out there and you're in this game, 11 to 12% is really not 11 to 12%, because if you're going to be doing a deal, on average, it should take you about 6 months from the time you buy it. Of course, if you're not doing new construction, I'm talking about rehabbing, from the time you buy it to the time you flip it. So if Rock East is lending you guys interest rates of 11 to 12, you're really only paying 5 or 6% for that money.
Yeah. Correct.
It's really cost effective.
Correct.
It's cost efficient to do this. So if you want to start scaling, because we have a lot of people who come to us and say, how do you guys scale? Well, you're going to need access to cash.
Correct.
And that's why we're having Rock East on the show today, because by leveraging their company, you're going to be able to start growing and scaling your own business, which in turn is going to allow you to get more deals and keep your contractors busy. And so it works. It works for everybody.
Correct. I think that's the important point. Where we come in is many of our clients have money. They've been successful and they have money, but they're leveraging our money so
Sure.
they can do
More deals.
2-3 deals a month.
Right.
We have a client who last year did 50 houses with us.
Wow.
So, and he's
Good client.
obviously very successful, but he uses our money to do 50 houses.
That's awesome.
Yeah.
Yeah, and listen, he's smart to do that. He needs you can't. I don't care how much money you have. You only have a certain. There's only a finite. There's not a finite amount. There's only a certain amount. And so if you want to do 50 deals like this other gentleman, and you only have $1 million of your own money, that's only going to get you to do maybe 3 or 4 deals in a 6-month time frame.
A couple.
Correct.
Absolutely.
Correct.
That's it.
You're out of money.
You're out of money.
Very quickly.
You're out
People
of
don't
money.
realize that.
Yeah, you're out.
Exactly. And so, if you're working with a realtor, and as you know, contractors and crews are very important. And if you're not keeping them working,
They scurry off to somebody else.
scurry
They
off
move
and,
on to the next. Yep.
and you lose them, and
Yeah.
they're not, and they don't come back. So,
Yeah.
and if you have a good crew, which is one of the big keys to this business, is having a good contractor who knows the business and knows what you're looking for, and if you lose them because you're not providing them work, it's tough to find that again.
It
Yeah,
is.
It takes years to build those crews. We've been there. Yeah.
And
Yeah.
whether
Years.
it's a realtor feeding you deals, and hey, he's Billy no longer can buy because he has no more cash. I have to find someone else who I can move my product to. So that's where it comes in for us.
You talked about a couple of one of the guys that was doing like 50 projects a year. Do you have a lot of guys that are just doing all renovations? Are they doing new construction? Any development projects? Different types of projects that you're funding?
We have one project that we're doing in Brooklyn that's new construction. Everything else we're doing is 1 to 4 families, buy, fix, and sell. Some of our investors are, going up, adding
That's
a
where you
second
add value.
story.
Yeah, second
They
stories
add
is
value. So
That's a lot right now. Taking
but-
the tops off, second
but
stories going out.
everyone else is just coming in and buy, fix, and sell.
Very risky for you guys to get into the new construction business, isn't it? Because of the timeline. If somebody goes in there, it's a lot of time.
It is a lot of time. It is a lot. So we have a very strict, underwriting for our investors who are doing new construction.
construction.
You have to show me at least a minimum of 10 projects that
There you go. So that's
you
the
have
criteria.
done.
Okay.
But it's also on
good
your
credit.
end as the investor. Velocity of money. You want these investors to get your money in and out within 6 months. If they're holding on to it for a year or 18 months, you're actually losing money because you're not able to turn that dollar over and make your points.
Correct. So it's a good point, because the misnomer is well, if I keep my money out from you for a year, that's great because you're just getting interest. It's not.
Right.
The deal is, to
Velocity.
turn over the money. So
Yeah, because you're making you 2 points every time it turns.
exactly.
Yeah.
Exactly.
That's revenue. It's lost revenue.
It is.
Regular
It is.
people don't get that.
Nope.
But this was a solid guy. I've known him for many years, so we went with it. And it's funny. He started in about May. He still has not taken his first draw. This is in Brooklyn.
Of course, it's in Brooklyn.
No, the city's
All right, ladies and gentlemen, this is Billy Alvaro, Wayne Hartop, Rick Haberman from the Rockies Group. We are Easy Sell Property Solutions. We'll be right back right after these messages.